What I'd like to try and do is really give a sort of 40,000-foot look at the Chinese economy and really just make 3 points. The first point is the Chinese economy is going through enormous changes right now that are absolutely inevitable. And these are the changes from an economy that's going through its extremely rapid growth phase, the 10% growth phase, to an economy, semi-mature, middle-income economy that's going to grow at a much lower rate, but unfortunately nobody knows exactly what, but let's say 6%, 5%. That's the first point. The second point is that the Chinese government, as is its tendency, rather than kind of laying back and letting things happen, because the Chinese government doesn't lay back and let anything happen, is developing selective policies to sort of accelerate this change. And the third point is, really, so far as we can tell, generally speaking, those policies to accelerate the change aren't really working and are creating an accumulation of problems that's creating more pressure for more dramatic economic reforms. All right, so let's look at each one of these 3 points in turn. First of all, the change in the Chinese economy. I mean, really, in a way, what's happening in China today is very similar to what happened in Japan in 1973, what happened in Korea in 1997. As the economy starts to mature, as the underutilized labor in the countryside comes to the city, as the labor force growth slows down, wages start to rise, capabilities increase, competitiveness in low-wage labor starts to erode, and the ability of the economy to grow at these super, super fast rates, 10% or so, really disappears. I thought Yu Hong said something really great about the relationship between China and the US, because she said, until recently, the division of labor between China and the US was really well understood. And that's so true, right? The basis of our economic relationship, until really recently, was the idea that Chinese workers were extraordinarily capable for their low wages, but that the division of activity was going to be very much one where China engaged in the relatively so-called low value added, labor-intensive stages of production. And on that basis, the cooperation between China and the United States was extraordinarily deep and extraordinarily profitable. Now that basis of the division of labor is disappearing. And it's disappearing for 2 reasons. One, Chinese wages are going up really fast. And so different things that used to make sense in China start to make less economic sense. People start to look around for other low-wage places where they can get things done. But equally important, maybe more so, is the dissatisfaction that the Chinese government, the Chinese policymakers, and we should say many Chinese intellectuals as well, the dissatisfaction that people felt with this niche or this place in the overall global production system. So Chinese policymakers felt very strongly, we don't want to be the low-wage ghetto for the global production networks run by Apple or run by many different companies. We want to seize control of those networks, nationalize them, not in the sense of making them state-owned, but making them part of our domestic economy so that we have lots of the higher-end activities as well. So that fundamental basis for the relationship between China and the United States is increasingly challenged in China, both by economic changes and by political changes. Now, the Chinese government is deeply ambivalent about this economic slowdown. Certainly they acknowledge that economic slowdown is inevitable. But at the same time, policymakers want to keep the economy growing what they call medium fast. And so the specific manifestation of this is that Xi Jinping has declared that by 2020, the economy is supposed to be twice the size that it was in 2010. And that means a growth rate of 6.5% per year has to be maintained on average between now and then. So lots of economic policies are being rolled out that are trying to keep the growth rate at least 6.5%. An undertaking that I think is basically futile. Why is it futile? It's futile because these economic changes are so powerful. And in particular, when I said other East Asian countries have slowed down at a certain point in the development process, that point in the development process is what we sometimes call, economists sometimes call the Lewis turning point. It's the point where as I said a moment ago, the underemployed labor in the countryside is exhausted. That's definitely happening in China today. But something else is happening in China today that didn't happen at the same time in other earlier developing East Asia countries. And that is that the total size of the labor force has also peaked and is now declining slightly and will continue to decline more. Now, this is something that did eventually happen in both Japan and Korea, but it's happening much earlier in China. It's happening earlier in China because of the one-child policy, now abandoned because of this negative economic effect. And it means that the changes in the labor force are occurring in a very, very concentrated window, driving other types of economic change very, very quickly, and thus making something that's more difficult for policymakers to deal with. So that's the first point, and I just want to say, when you hear people say, oh, the Chinese government is trying to change the development model, you should always take that with a grain of salt. It's not that the Chinese government is trying to change the development model. It's that the Chinese government is trying to respond to these profound changes in the underlying economic structure and adapt what they're doing to try and make something more appropriate. Well, what could be more appropriate? Well, in fact, there's enormous agreement about what kind of things are needed as an economy shifts from the high growth phase to the middle income, medium growth phase. And let me just give you two examples. One, of course, is that the economy needs to shift to a role in which innovation plays a more important role. Boy, if there's a lesson that's been internalized by Chinese policymakers, it's that one, right? You can hardly open a newspaper in China without seeing a reference to innovation-led growth and to government policies that are designed to foster innovation-led growth. If you look at the level of inputs into technological change in China, they've exploded over the last decade. China now invests more than 2% of GDP on research and development. And of course, the number of Chinese going to university and graduating from university has exploded from 10 years ago, 2 million, just a little below 2 million, to today, 7 million. So they're certainly putting money into this process. In fact, they're putting literally hundreds of billions of dollars into new, especially so-called strategic emerging industries, which includes electric vehicles, it includes commercial airliners, it includes a whole range of things, including some of those sectors that Deborah Seligson was talking about, where we're starting to see some real positive movement in some of the environmental sectors. The reason for that, or at least one of the reasons, partly it's socially driven, sure, but partly it's industrial policy driven. That planners see these sectors, like electric vehicles, as sectors of the future, growth sectors of the future, where there are not existing incumbents in the West or Japan, and where therefore they think Chinese upstarts have a chance to become the crucial global leader. So think electric vehicles where, okay, Tesla is a great company, but it certainly doesn't have an entrenched incumbent position. China's got 3 or 4 electric vehicle producers that planners would like to think of as the leaders of the future. So we see, in that sense, Chinese government trying very hard to drive forward the kind of change that would be necessary to shift to a sustainable growth process given this new growth environment. Second, as you move to this lower growth path, you have to move out of a lot of the things you did before. Right? As growth drops, investment should drop, because a lot of investment has been in things like steel mills that are in turn designed to serve investment in housing, factories, highways, etc. And so, of course, once the growth path changes, you have to move out of things as well as move into things, right? It's not enough to move into electric vehicles. You also have to move out of the production of steel and cement. And so China this year, starting last December, has introduced a very aggressive and multi-sided policy called supply-side structural reform, which means, well, what does it mean? It means many things. It has 5 initial components, and it has many different kinds of content. But step 1 in supply-side structural reform is reducing excess capacity in steel, cement, and a number of other sectors, selling down excess inventory of housing that's been unsold, lowering costs for firms, and facilitating the withdrawal from obsolete, overbuilt sectors, especially in the heavy industry sector. So look at these 2 initiatives, just to take them as examples, right? Investing in technology and retrenching out of the old heavy industrial sectors. That's the right direction to go. It's essential. It's the way China has to move to utilize its reserves of skilled and increasingly well-educated manpower, and increasingly expensive manpower and woman power. So in a sense, this is a kind of industrial policy, just in the sense that Japan and Korea also followed industrial policies to push their economies into, in that case, heavy industrial sectors more rapidly than they were going to grow without the government's push. But it's a kind of super industrial policy. It's a super industrial policy because China's so much bigger. It's a super industrial policy because the amounts of money are so much more enormous. And it's a super industrial policy for one other reason. And that is, there's something deeply counterintuitive about the government acting in this way. This is the moment when the government in Japan and the government in Korea started to say, we're becoming a more sophisticated economy, therefore maybe government planners don't know so much better than businessmen what to invest in. In other words, this is the moment of development where Japan and Korea shifted to what we might think of as a light touch industrial policy, where they stopped targeting specific things and they said, well, we're going to invest in some research institutes, we're going to subsidize some activity here, but we're going to pull back and let the business sector make those decisions. So what's peculiar here is that just as China reaches this point, just as it reaches this turning point, the government is in fact becoming more interventionist, more dirigiste. They want to steer the economy more and affect it more. So in a sense, it's the government kind of pushing open an open door. Market forces would make this happen, but China's government wants it to happen faster. And so the government's intervening more. Now, it seems to me this creates problems for China. I'm going to take a little, I'm not going to try and be totally neutral here. I'm going to take a little bit of a, this is my opinion, but based on a reasonably fair assessment, I think, of what's been going on in China over the last couple of years. I suggest that in most cases, government policy to achieve these changes has not been particularly cost effective. Number one, technology policy that I was just describing. Basically, China's been throwing money at problems. And the problem in assessing these outcomes is, number one, we don't know how much money it is. We know it's a lot, but we don't have good numbers to follow, to track in individual sectors. And number two, it's hard to see success at this relatively early stage. But even a preliminary evaluation would lead us to say, China has some great companies. It has some really innovative companies. Those companies have benefited a little from government subsidies, but the areas where really big government subsidies have gone have not produced very substantial outputs. And when they have produced results, they've been at very high cost. So I think people in China who follow technology policy feel like, boy, we need some big successes. This policy is shaky, let's say. Number two, state-owned enterprise reform. Here we see China really, this is in a way the first year for state-owned enterprise reform because they spent 3 years arguing about it without reaching consensus. They sort of reached a consensus document in September of last year. This year they're starting to carry out state-owned enterprise reform. So many different things are happening, tugging in different directions. And to make a long story short, the force that's tugging them backwards is the feeling that state-owned enterprises need to be overseen more tightly, both by the party and by the owners, the agencies that execute government ownership. So that even though in some ways state-owned enterprise reform has been moving forward because we've been adopting better corporate organizational forms, more boards of directors, at the same time, just to take one example, the party is also saying, well, you've got a board of directors, that's very excellent, but guess what? The party sets the strategic direction for the board of directors. And so, since the party has mixed motives besides profit, that undermines the key issue. Number three, opening up the capital account, the renminbi. China is in a really strange position right now. China on the trade accounts, the cumulative trade surplus for China over the last 12 months is $600 billion US. So that's a little over 5% of GDP. I mean, China is developing a trade surplus, not quite as big, but almost as big as the big one in 2006, 2007. It was a major source of conflict with other countries in the world. Now, it's a little bit less of a source of conflict because everybody understands that the main driver of this big surplus is the drop in oil prices, drop in raw material prices. China's a big consumer of raw materials. But consider this odd scenario, right? China has a huge trade surplus, and everybody's worried that their currency is going to depreciate. That's backwards. There's something wrong. It means there's a pent-up demand to move money out of China, and that's making it very difficult to open up the capital account and liberalize in that area. The solution would be greater liberalization of financial markets in China so that people would find it attractive to be investing financially in China at the same time that Chinese people are investing outside of China. And fourth, and finally, the shift to the service sector. Part of this change to the new growth environment has got to be to shift from manufacturing to service. There's some data that seem to suggest this is happening. That data is entirely a price phenomenon. If you look at real growth rates, the industrial sector is still growing at the same speed as the service sector. And the reason for this, I suggest, is when you actually drill into it and look at the high-quality service sectors, the skill-intensive and capital-intensive service sectors in China, they're almost all dominated by state firms. So Each one of these 4 areas, I would argue, change is going a little bit more slowly than we would like, than Chinese policymakers would like, and it's not hard to see why. The reason why is they need to do more with market-oriented economic reform, and only with more market-oriented economic reform are they likely to actually be able to address these issues. Thanks.